This video is going to address categorization of managed futures performance. And what you'll find is there's a host of categorization methods. This method specifically looks at what drives performance, because what drives performance is the most important component in analyzing a managed futures investment. So the way we look at performance and categorization is based on the macro performance drivers inside a strategy. The strategy is important to understand because the strategy defines the risk management parameters and the entry and exit points. So by strategy, what we mean is something that determines the trade decision. So if it doesn't determine the strategy decision, then it's a component of the strategy, not the strategy itself. I'll give you a couple quick examples. A market traded is not a strategy. It's a component of a strategy. Same with trade time frame. They are not strategies, they're components of a strategy. Relative value is a strategy. Carry trade is a strategy. Short volatility, long volatility, trend following, counter trend following. These are all strategies that determine how decisions are made. So what this method does is it understands the strategy and then relates it to macro performance drivers. And there are certain market environments in which these strategies benefit and certain market environments in which these strategies find difficulty. The key is understanding the CTA first at a high level. Take that high 50,000 foot look at a CTA. Understand their beta market performance drivers. Then drill down into the individual alpha. That's what this system's all about. We're going to have a video at a later point in time that actually demonstrates how this system looks at a CTA. It's about an hour-long video. It's a very detailed analysis of a particular CTA. But it starts with a pyramid approach. Take the basic steps first. Then once you've mastered the basic steps, you have the basic understanding of the overall strategy, then get into the alpha. Then start to understand the secret sauce that makes this CTA different. While two CTAs may each be executing the same overall strategy, their alpha factors in how they position size, how they enter and exit trades, and how they manage risk can be very different. And this all fits in to how you're going to diversify a portfolio. Performance drivers and categorizing managed futures CTAs based on performance drivers is done for the purpose of diversification. Here's a quick example. There are different types of performance drivers. For instance, we have the performance driver of price persistence. Price persistence is normally associated with trend following and counter trend following patterns. Then we also have relative value strategies. Relative value strategies, the performance driver is divergence and then convergence back to a statistical mean. There's a market environment for this. And then there are volatility strategies. Volatility strategies are corresponded to market volatility. Some of these strategies benefit when market volatility increases, and some of these strategies are significantly impaired when market volatility unexpectedly increases. When categorizing managed futures investment based on performance drivers, a professional asset manager should be able to explain the investment in a sentence or two. This compact explanation provides critical detail that assists in setting proper performance expectations for the investment and providing a solid foundation for exploration into alpha returns and risk management considerations. This is critical. Professional asset managers must be able to explain in understandable terms how and why managed futures works, as well as set proper expectations for performance, both positive and negative, on a going forward basis. You can explain the investment, why it works, when it works, and how it works, in a couple easy paragraphs. It's traditional for equity investors to understand how market environment impacts a particular stock strategy, and the same holds true in managed futures. That's why it's important for investment managers to understand the macro performance drivers first, build that foundation, and then from there understand the investment.